faculty members and students present here today. It is truly an honor to stand before you as we embark on yet another enlightening session of Juristic, a platform dedicated to expanding our understanding of contemporary legal and financial matters. Today, we delve into an intriguing and high relevant topic, decoding joint development agreements, GST implications, a subject that holds immense significance in the realm of taxation, business transactions and real estate. Before we proceed, let us take a moment to acknowledge the institution that has made this insightful gathering possible. Decoding International Business School, also known as GIBS, has been a pioneer in academic excellence since its inception in 2004. Affiliated to Guru Gobind Singh Indraprasth University, GGSI, New Delhi, and approved by AICTE and Bar Council of India, GIBS offers a diverse range of programs including MBA, MBA International Business, MBA Integrated, BBA Honors, BA LLB Honors, BBA LLB Honors, and LLM. GIBS is committed to fostering intellectual curiosity and professional competence, ensuring that students receive holistic learning experiences. With its A-grade accreditation by NAC in its third cycle, the institute continues to uphold its legacy of academic brilliance and industry-oriented education. Now, it is my privilege to introduce our esteemed resource person for today, CA Gaurav Makhijani sir. Makhijani sir is a distinguished chartered accountant with a postgraduate in business finance from Symbiosis University, Pune. With over 17 years of extensive experience in taxation, he is currently the head of tax, North India and Gujarat, and associate partner at RODL and Partner India. His expertise spans across international taxation, corporate tax strategy, regulatory compliance, mergers and acquisitions, and cross-border taxation. He has previously worked with global consulting giants like Deloitte and PwC, adding to his vast industry exposure. Beyond his advisory role, he has been active contributor to tax policy discussions, engaging with embassies, industry associations, and regulatory bodies. He has also briefed senior counsels on complex tax litigation cases before the authority for advanced rulings, High Court, and the Supreme Court. A prolific speaker and author, he has been a guest lecturer at various prestigious events organized by the Indian embassies in Germany and Switzerland, the Austrian Embassy, and the Indo-German Chamber of Commerce and VDMA, German Mechanical Engineering Association. His insights have been widely published in Economic Times, Times Now, ET Now, and professional journals. Additionally, he is the author of Bloomsbury Desk References for Professionals, a valuable resource for tax professionals. We are privileged to have him here today to shed light on the critical aspects of joint development agreements and the GST implications. Please welcome him with a huge round of applause. As a token of our gratitude and appreciation, we believe in fostering an eco-friendly tradition. To honor our esteemed speaker today, we would now like to present a green welcome, a symbol of our commitment to sustainability and a gesture of respect. Please make a hand. With that, I would now like to invite Gaurav sir to take the stage and enlighten us on today's topic. Let's give him a huge big round of applause.
Thank you. Good morning, everyone.
Good morning.
So nice to be here among young fellow future lawyers. I'm Gaurav Makhijani. Thanks for the wonderful introduction. I'm Gaurav Makhijani. I'll just talk about, take 2 minutes to talk about my firm. It's Roeld and Partner. It's a German consulting firm where we are supporting primarily German speaking nations, which is Germany, Austria, Switzerland, who wants to invest into India. So primarily guiding them to make entry into India. If they're already in India, then guiding on the consultancy, professional side, legal side, taxation side, on what challenges they could have in India, or their compliances, what they need to take care from legal perspective and tax perspective. So what I thought before coming here today is something where we had to talk about the joint development agreement on GST, But as a lawyer, what I understand is you guys would want to, maybe some of you would want to become a corporate lawyer. Some of you would go traditional and want to become a litigator. And some of you might want to go into some management consulting or have some other path. So I think for each and every one of you, important would be, because I come from tax backgrounds, of course, the bottom line of our discussion today, the conversation today would be taxation. But I just wanted to connect tax with what you're actually studying and also how it can be relevant for your future career, future profession. So, I mean, we were just thinking on what topics to take, and the idea came up that let's talk about agreements, also covering, of course, this curriculum of choice and learning agreement, the GST topic we have. Can you go to the next slide? Again, next slide. Right. So, when we are talking about agreement, we have to see what are important tax clauses in the agreement, of why tax is so important in the agreement drafting. Because this is something, agreement drafting is something which as a advisor, as a corporate lawyer, or even as a litigator, you will have to deal with day out in your career. So can anybody tell me what are important tax clauses or why tax is so important when you're looking at agreements? Anyone? No problem. So of course, tax is something which has cost attached to it. If you are talking about goods and service tax, if you're talking about income tax, if you're talking about capital gain tax, whatever you earn or whatever you spend, there's some tax cost attached to it, and it affects your pocket. For business purposes, then it affects your cash flow management, it affects how much you will take home after profits, what tax you have to pay on the profit or what tax you have to pay on the income. And of course then your net income which goes into your pocket depends on the tax aspect of it. So it's very, very important as a lawyer also, when we are looking at any agreement, there are different kinds of agreement which I'll talk about, and what are different kinds of tax clauses, what are different kinds of tax impact on agreements I'll talk about. So there will be various different agreements, etc., which you will deal in day out, and there are different types of tax clauses which are very, very important for a lawyer to understand. So to start with, it's actually very important when we are dealing with agreements, because agreement is something which is a written form of arrangement between two parties. It could be either a sale agreement, a purchase agreement, joint venture agreement. Drafted agreement is to ensure that we are clear whatever we have agreed in verbal. It's clear, it's in written form, and that's something which we can then refer to in future in case we have any problem. We can go back to our agreements and see whether the clauses we have agreed on day one while we thought that we enter into business transaction. If we have any dispute, we can then look at the agreement and then sort this out, or rather than having to go to arbitration or litigation. So it's important that in the agreement we have to ensure the clarity between the parties. Now from tax perspective also there are a lot of aspects. Just to give you an example, if you are tomorrow employed by a company and you are getting salary, in your employment agreement there will be clauses on taxes, that taxes would be withheld from your salary and net amount will be paid to you after deducting all the taxes. Now this is something which you understand on day one when you enter into employment agreement, and after that, in case you have any challenges, you can go to your employer and say, see, this was the understanding I had when I entered about my salary cost, this would be the withholding, this is how it would be done. So it provides clarity between the employer and employee. In case of any confusion, I can go discuss with the employer and get this sorted. So tax clauses are important to ensure that there is a clarity between the parties. This accurate cost calculation is very, very important for business, for individual, for everyone. Now, if you can sit here in the front row. that cost computation is accurate and to ensure that there is a clear understanding of cost also among the parties, it's important that agreement has those clauses. To give an example again on GST. Now, when we are dealing primarily with government organization and we have some sale agreement to government. So for example, we are providing agriculture, food, etc. or vaccines to the government. Government may say that we will not apply GST on those particular few items, for example, milk products or something. So, as a business, when I am supplying my goods to government, it's important that I understand that when I am not charging GST to the government when I am selling the goods, but at the same time, I will have certain purchases. For example, I will pay lawyers, so I have to pay the GST on the research charge, I have to purchase other services, other goods for my business. And in those cases, you will have input GST. Now, input GST is something which you usually offset with output GST, that's how GST works. But in case your output GST is exempt, there's no GST which is payable, the input GST cannot be then taken as a refund, it becomes cost for you. And therefore it's important that when as a lawyer drafting any agreement, I need to understand what would be the tax implication of that transaction, draft the agreement accordingly with the government. If I have to work on my budgeting as a lawyer, I would write, okay, there's something with GST challenge which came up, you would not be able to claim the input GST credit. And therefore, it's important that in the agreement today or in the budgeting today, I should ensure that my profit margins are charged accordingly. Or if I am entering into agreement for purchase of services, I would rather have an agreement for inclusive of GST or something of that sort. So again, the idea is that why tax clauses are important. Tax clauses are important because first I need to understand what would be the tax cost of it and accordingly inbuild all those aspects in my agreement so as to ensure that my future projections etc. Is not affected. And effective compliance. Now again, tax is a law. So of course, to enforce that law, there are certain compliance talking about the salary employment contract. Now in that case, you are getting a salary and your taxes are withheld by the employer and then deposited by the employer to the government. Now, there's something called Form 26A. This is basically a summary of all the income which you have received and all the reporting which has been done from the salary which you have received. And it actually provides all the summary which helps you to file your tax return in future after the year. Now, if I have to really ensure the compliance management, I have to ensure that the employer is filing the withholding tax on time, correctly of whatever salary he has paid, whatever withholding he has done, is appropriately reporting that particular aspect of withholding tax in the withholding tax statement to be filed by the employer, so that the tax which has been deducted from my salary is appearing on my Form 26A appropriately. So that tomorrow, in case I file my tax return, I do not face any time. And therefore, to enforce that law, there is a compliance that needs to be done. And in the agreement, it's important that all those aspects are carefully written so that I do not face challenge. And in case my employer does not file withholding tax on time, I have to bear the cost of it. I can recover those costs formally. So, as an employee, I would be interested and I am signing the agreement tomorrow that all those aspects of the agreement, my employment contract are carefully mentioned. That what will be the withholding tax, who will do the compliance, what will be the responsibility for me, what will be the responsibility from my employer, if something goes wrong, whom should I contact, where will be the arbitration, etc. done, for tax clauses. So all those aspects, something which is written. In a simple employment contract also, there are a lot of things which might come. Now here we have tried to give few different examples of tax clauses in the agreement. First I am covering goods and service tax. Can we switch off this tax law? It provides that whenever there is some value addition done on the supply chain of the goods or the services, the tax would be added on the value added part. The way it works is that if I have to, manufacture something. So the way it works is that I will purchase raw material, I will manufacture it, I will sell it to the wholesaler, wholesaler will sell it to the retailer, and then retailer sell it to the end customer. So when raw material is purchased by a manufacturer, he would pay some tax, GST on it, or because it's applicable both on goods as well as on services. So when I purchase those goods, raw material from any supplier, I pay tax on it. Say for example, if I am purchasing 100 rupees goods as a raw material from someone, I pay 5% tax, 5 rupees tax. Then I make some value addition. I manufacture the goods and I sell it on 120. Now 120, I again apply say 10% tax because the tax rate may change on different products. So the form of the product is changed. 10% tax is applied when I sell the goods. So 12 rupees is something which I will collect from the wholesaler, which I have to pay to the government, and 5 rupees I have already paid to the raw material supplier, which would become my input. So because I have added 20 rupees and because of some tax rate differential, 12 rupees minus 5 rupees is something I have to pay to the government at the end of the month, and I have to file certain compliance as well. So this is how basic GST works in all the scenario. There is input tax, there is output tax. At the end of the month, I file primarily 2 returns, and in some cases 3 returns, where I have to disclose what is my output GST, what is my input GST, and what is payable. And in one return, I have to actually say how I am paying the taxes. So this normally works. Now, when I am talking about clarity on tax applicability, I have already discussed that GST. When, for example, I am dealing with government organization, then it may happen that in some cases, because it's a value-added tax, so I am depending on my output GST and then input GST, and the difference is something I am making payment to government. Now, in some cases where I am dealing with government or where there is no GST on my product, so there is no output GST, in that case, as per law, input GST is something which is not allowed as offset because there is no output GST from which we can offset, and also I cannot really take refund of that input GST. So in that case, what happens is that this becomes my cost. If I have purchased 100 rupees raw material, paid 5 rupees tax on that, the additional 5 rupees which I have taken, ideally it should have been available as an input GST. And when I am doing the budgeting, I would say, okay, this 5 rupees is not my cost. I will anyway get either refund or the credit or the offset for this. But because my supply was made to such an organization that it become cost to me. So 5 rupees, 5% cost for business overall when aggregated is quite high. So in that case, it really impacts your profitability statement, it impacts your businesses. So it's important as a lawyer when you're dealing with such transaction that even if you are like going as a litigator, if there is a dispute, so you basically understand how to read those clauses, what certain GST measures, GST aspect was covered or not. And as a corporate advisor, of course, it would be your responsibility that when the party is at the negotiation table, you have all those aspects carefully considered that, today when I am dealing with this, when I am negotiating with the party, I will see what kind of transaction I may enter tomorrow and what would be the cost implication, and then in the agreement carefully drafting all those aspects. As I mentioned, if I have to carefully say that I can purchase only, or I can in my budget say I have budget of 100 rupees only. So and then enter into negotiation with my raw material supplier, I will say this 100 rupees is inclusive of GST, and that clarity of GST is something which I will provide in my agreement. So when I say I will add a GST clause in the agreement, then I would say that the prices agreed between the party is inclusive of GST. In that case, also the party which is supplying would provide the tax invoices, would declare or take my GST, so that tomorrow in case I am supplying this to any other person other than government and have output GST, I can really take those benefits. So all those clarity is something I need to counter that. The next point is again same prices to be either it will be exclusive or inclusive. Then proper invoicing with accurate particular is something very important. So when we are drafting any agreement of say supply chain, purchases or services, these aspects of GST clauses are very important. First is the clarity of whether it's inclusive or exclusive. Then the proper invoicing etc. would be provided by the supplier. So whoever is supplying the raw material, when they would issue invoice, they will issue invoice on tax invoice. They would have proper particular, so that I can take input tax credit. So all those aspects are something which needs to be mentioned in the agreement. And then in the agreement, it's also important that I put compliance responsibility on the supplier. That the supplier would file the returns at the end of the month and would provide the usual, so that tax credit property. And in case the tax credit is not available, then I should be able to recover all those costs from the supplier. So that was all about the GST aspect. Any questions so far on the GST related law? Any question? So we'll move on to the next aspect, next tax. So GST is something which is primarily more or less simple, that we need to ensure who would bear the GST. I would put responsibility of compliance on the supplier side, so that I get input tax credit. Next important aspect of tax is when I am dealing with the agreement is the withholding tax. Now, withholding tax aspect is something where, as I mentioned, when I am looking at the employment contract between employer and employee, it impacts my cost or my takeaway salary. So, at times we see normally when we are talking about expatriate salaries that they are coming from Germany to India, like example, we draft an agreement and we provide that the taxes which is payable in India is something which is to be borne by the employer. And in our cases, in regular local employment contract, we say that the taxes would be withheld by the Indian employer and the net of tax salary would be paid by the employer to employer. So in these cases, we see that it's important when we are looking at withholding tax clause. So when we are drafting any agreement, we look at GST, whether it's applicable or not, all those aspects and all. We also have this separate clause, withholding tax clause, where we mention whether the withholding tax is to be borne by the payer or it is to be borne by the payer. Whether it is to be borne by someone who is paying the amount or someone who is getting the amount. Then, similar to GST, where the compliance is something which is clarified in the agreement, it's very, very important that for the withholding tax aspect also, the compliance aspect is entered into the agreement, so that the party which is withholding the tax is it's binding on them to ensure that they enter all this information in the withholding tax statement, and I am able to get the credit for the withholding tax. Because if I have agreed for a transaction and agreed for the withholding tax, I am getting 100 rupees. I was supposed to get 100 rupees as my income, and 10 rupees is deducted. I am getting only 90 rupees as my income. Now 10 rupees is something which should be available as a credit, because when I file my final tax return, it is something which otherwise, if it's not appearing in the form 26, I have to pay from my own pocket. Then I got only 80 rupees from that 100 rupees income which I have. So it's important that the party which is paying file the withholding tax statement correctly, enter my PAN number, so that I am able to get this credit on time. So from our perspective, when we are drafting any agreement as a lawyer, it's important that we understand what is the withholding tax aspect, whether it's a gross up withholding tax concept or a net of tax withholding aspects, and then also bind one of the parties would be doing withholding, so as to ensure that the withholding tax compliance is done properly and the credit is done. Other party is also to be made responsible that whatever information would be required to file the withholding tax statement should be provided, so that it should not happen that I do not have information but I still raise a claim against the party that you should, because I am not getting credit for XYZ amount, I should recover this from the other party. So the thing should be clear, whatever has been discussed, agreed, should be made in writing. So glossary clause I have already covered. Now, There are other tax clauses. There are of course boilerplate, but when each party is responsible for their own compliances is something which we usually mention. For example, again going back to very simple agreement of employment contract. Withholding tax is something we already discussed that would be deducted, and withholding tax statement would be filed by the employer. But what about the income tax return? Whether this would be also filed by the employer? Few people in practical we see that acha mera to withholding tax, okay, I don't need to file the income tax return. So it's very, very important and to have this in writing in the agreement that I am making the payment for salary and I will do only the withholding tax compliances. The final, whatever compliances you have for your income tomorrow, that is something which as an employee you have to or you have to ensure that compliance. So if you are supporting the employer for drafting the employment contract or drafting the director contract, you have to ensure that all those aspects of each party is responsible for their individual compliance. Something as a clause is definitely not missing. Otherwise it is create or indemnification is something, because anything goes wrong, we go and see whether we had an indemnification clause. So if any party had done anything wrong or not done correctly, at least the other party is indemnified and then is able to get the amount or get some other benefit from the wrongdoing which other party has. And in that case also, in the indemnification they could arise some tax implications. If I am getting amount as a penalty, whether tax implication would arise on that, and who would be a tax on that, whether I will be included. So tax on tax, because of the indemnification on the tax clauses, you could have separate tax implication. Whether then in that case separate compliance is also mentioned in the agreement. So you would see whenever you see any agreement, there will be different clauses. Basically, what we talked about compliance aspect. There would be a boilerplate indemnification, but in that case, indemnification would also have certain tax implication, which is also mentioned in the agreement, which makes the indemnification clause little lengthy. Usually, when we are dealing with any foreign party on a long-term contract or also a domestic party on a long-term contract, we have this clause that in case tomorrow there is a change in law, then parties should sit together again and then discuss what should be the implication. So there should be an option to renegotiate if there is a change in law. Now, we see that nowadays they are talking about income tax, new income tax bill which has been placed in the parliament, and it would be now passed this next week. So if I have something agreed with my employer today, and I want to really renegotiate because there's a lot of changes done in these tax clauses, whether I could write something to keep that option open is something one could look at. Of course, this is something which is not very difficult, usually in the employment contract. But when we're looking at a long-term contract, specifically with the cross-border transaction, we usually have this clause. So this is something which we see as a normal clauses when we are drafting the agreement, which is the clauses which we talked about, which would have compliance, which would have inclusive, exclusive, which would have the indemnification, etc. Similar for withholding tax, whether the withholding will be done or not, gross up or not, compliance, who would take the compliance version and indemnification, etc. also about withholding. Then comes the other local supply. So this was on the local supply agreement, very, very routine, very normal, not so complicated, but still very, very important when you're looking at the agreement. Go to the next slide. Now, cross-border, very technical. As a lawyer, in today's world, when there's so much of globalization, when you join Indian law firms like AZP, we talk about JSA, we talk about DSK. When we are dealing with them, we very often hear about dealing with Japanese clients, dealing with Polish clients, German clients. I keep on dealing with German clients in daily work. And on everyday basis, I am dealing with cross-border agreements. And their tax implications are very, very different because the party, maybe you're supporting a foreign company, they would not even understand what Indian tax law is. So you have to really guide them on a step-by-step process. So there are a few important points which I want to cover on what usually we see when we are drafting different cross-border agreements. So on a simple supply agreement, assuming that a German company is selling goods to a Indian company, there's something called input terms. So anybody can tell me what input terms mean? Anybody? No one. I think nobody is listening. So input term is something which is generally routine term. When we are looking at supply of goods from in a cross-border transaction, there are routine commercial terms, standard terms which are provided by the association. So it could be either FOB, CFR, DDP. And the idea is that if I mention CIF, so when a foreign company is supplying any goods to a Indian company, its cost insurance type, which is included, and any other cost or any other risk is then on the other one. When I'm talking about DDP input terms, it's a duty paid delivery duty paid. And in that case, the idea is that the party which is supplying the product, they have the responsibility of paying all the cost or the duty, the custom duty when the goods is cleared from India is to be paid by the party who is supplying the goods, and the other party who is receiving the goods gets the goods in their factory. So the responsibility, the title, etc. is transferred when I actually receive the goods from the India. That's very, very important as a lawyer to look at all those input terms, understand what are the implications, where the risk is being transferred, where the title is being transferred, who would bear the insurance, who would bear the duty claims, etc. And what are other implications of that. So that it's important that tomorrow if anything goes wrong, if the goods get damaged on the sea, who would get the insurance money, who would get the responsibility clear if there's some nature environment challenge. So input terms is something when I'm sitting at the negotiation table as a lawyer, I need to understand that first and then guide my clients and see this might be risky for you. If anything goes wrong, the Indian customer is not going to payment to you. So how do you recover those? So as a lawyer, it's important that I understand those input terms, the title aspect, and then have this included in the supply agreement when you look at a cross-border affair. Generally, this is not something which is applicable on the local supply, but only in the cross-border supply. Now, clarification on withholding tax is something when, so it's a basic principle that whenever any party from abroad is supplying goods to an Indian customer, it's not subject to tax. Goods supplied because everything on that goods is done outside India, the item is also transferred outside India. Nothing is done in India, only the Indian party is paying the pay. So in that case, nothing is taxable. But Indian government or the Indian party may say that, see, if I am making payment to you, I have a responsibility to withhold tax because tomorrow, specifically in the cross-border transaction scenario, government will catch me as an Indian person because they can only catch me, foreign company they cannot control. So in that case, they mostly take a conservative view of Indian party and they withhold some of the other tax, or they require a lot of expensive documents to ensure that withholding is proper. So when I am actually trying to help my foreign company, or other way around, if I am supporting Indian client also when they are purchasing from a foreign company, I need to understand whether there is a tax which would be applicable on the supply of goods from outside India, generally not. What are the documents which the party would provide to each other so that withholding is not done, or if withholding is done, then what should be the compliance which should be done. So there should be clarity on what is to be done, there should be clarity on who will be involved, and what compliance need to be done as far as tax is. This is a major issue when we are dealing with the cross-border transaction. This is something which, if you are going for a internship as a lawyer drafting an agreement, this is a topic which would keep on coming to you. Input terms, withholding tax is something which firms like ACB, firms like Khaitan would expect that at least as a lawyer, if you are studying in law college, you should know all this aspect, at least basic parts. Custom duty and GST. Now, taking a step forward, when we are importing goods, we talked about input terms, title, legal aspect, we talked about withholding tax aspect, limited tax implications. There's a custom duty aspect as also. Now, nowadays, if you see local news channel, Mr. Trump is already talking about tariff, this tariff, this on 2nd April, is the reciprocal tariff which US is planning to import on Indian export of goods. So a lot of discussions are happening on tariff, and that's nothing but custom duty. Now custom duty in India is of course a challenge. A lot of foreign companies they do say that custom duty in India is very low. For example, a bourbon whiskey which India imports charges 150% of custom duty. On some sports cars, imported cars which come in a package of 110% custom duty. The custom duty in India on an average, different products is around 15%. When we are looking at China, which we compare ourselves a lot, we say around 6%. So China is charging half or even less than half of duty. Countries like US or EU charge around 2%, 3%, very low input duty, very limited. So custom duty is very relevant in Indian context, and when we have something like free trade agreement, which is being talked about nowadays again a lot, that India is planning to do a free trade agreement. When you have a free trade agreement, you check whether your products which you are going to import is there in the free trade agreement, and if it's there, then custom duty is not charged. So in the agreement, you specify that because of this free trade agreement, my custom duty is not applicable, and therefore the party, even if it's an input on BTE contract, custom duty is something which is what? GST is something which is charged on reverse charges. As an importer, if I am importing goods, the primary responsibility of paying custom duty is on me. So when I am importing any goods, custom duty is say for example 10%. I will pay custom duty 10%, and over and above I will pay 18% GST on that. Now custom duty it is a cost to me, because I do not get any credit. If I am importing goods of 100 rupees, 10% is the custom duty. 110 becomes my landed cost. But if I have to pay GST over and above 18%, now that is something which again becomes my input GST, and then whenever I am selling the goods or using it for manufacture, etc., I get input and then I can offset that my output GST and I pay over the revenue. So input GST is something which is not a concern. In majority of the cases I get credit and therefore not a challenge. But custom duty is a challenge. But as a lawyer, it's important to understand both the aspects and have it in writing in the agreement when you are drafting the agreement. That was about supply of goods. I quickly move on to supply of services as well. We already talked about withholding tax when we are talking about supply of goods. If any foreign company is supplying goods to Indian customers, not taxable Indian, we already talked about it. But when we are supplying services, there is something called source rule which is applicable, and in that case, withholding tax is to be applied, and I can always pay balance. So for example, if I am purchasing services, IT support services, if I am paying to Microsoft, Facebook for certain services which are provided to me, or some repair services provided to me, there is a source rule. So even though nothing is being done in India, still India has power to charge 10% tax or 20% tax depending on which tax treaty I am looking at, which country I am looking at. So if 100 rupees is the price of the services, say example, India Germany tax treaty has 10% rate on tax rate on services. So the Indian party was making payment to the German party would withhold 10 rupees as a tax on services and then only pay 10. So withholding tax is something I also, when I am talking about service agreement, need to understand, have that in writing that okay, withholding tax would be applicable, and what are the documents which would be required by the Indian party to ensure that withholding tax is done properly. Of course, then grossing up a net of tax is very relevant. If you are dealing with someone like Google, Facebook, Microsoft, they might say, see, I need my 100 rupees, whatever tax Indian government charges, you take care of that, you do the grossing up. So the way it's done is that when I go back to my previous example of 100 rupees, I am buying certain software, certain services from Microsoft for 100 rupees. Now, 10 rupees is something which I have to withhold, deduct as an EDS. But Microsoft says, see, I don't care, I'll raise you 100 rupees invoice and I need 100 rupees. You do whatever you want, but pay me 100 rupees. But in that case, Indian party, what they can do or will do is, they will gross up that. How will they gross up? They will keep 100 rupees as a numerator. They will, in the denominator, they will say 100 minus 10% tax. bracket close percentage. So divided by 90%, which was to be paid to the party, they will divide that with that, and they'll get 111.11 as an answer, which will become their expense. 111.11 will be their expense. Now, if you apply 10% on that 111.11, it will come to 11.11, and the net amount which can be paid on is higher. So this way, you do the grossing up and make all the calculations. As a lawyer, it's important that you understand that if the other party is saying that I need a grossing up, or if in your case, then you should have that particular clause in the agreement that, see, whatever payment is done, it should be paid via grossing up, and then even though you're doing grossing up, the Indian party who is making the payment should do the proper payment, so that the credit is available. Because in case, even though I got the 100 rupees, but the compliance is not done by the Indian party, tomorrow if I have to file the tax return, but anyway, then make the payment of 10 rupees tax to the government. So it becomes cost again to Microsoft. So all those clarity is something which is required, and then we enter into itself as a services. There is some very interesting concept called permanent establishment. Now, foreign companies generally do not have any presence in India, therefore the tax implication is very, very limited. For example, if I am providing the purchase of any services to the Indian party, I do not need to maintain a books of account in India, no audits to be done, nothing is to do, no hard passport. It's just that something is taxable in India, withholding will be done equal to my final tax and my tax, that's it. But when you're talking about permanent establishment, the way permanent establishment gets taken is that you have a lot of employment interest in India. So either you have some branch office in India, a project office in India, a company like Siemens is working on a metro project in various jurisdictions. They have a very long sustainable presence where a lot of employees are coming for more than 6 months, 8 months, and depending on whatever tax treaty you're looking at, a permanent establishment is created in India. The tax rate for permanent establishment is as high as 35%, and you have to maintain books of account and the employee who are coming only even for 1 day has to file their taxes. The compliance burden is quite when we talk about permanent establishment. So in that cases, when you are looking at a transaction from a foreign company perspective, as a lawyer, foreign company or Indian company, you should clarify whether this transaction would create permanent establishment on day one, and then enter into agreement clauses accordingly. The other, as I mentioned, body big clauses. So payment term is something which you need to mention. Contract structure, when you're looking at say metro projects, as I mentioned, when you're looking at supply of goods, it's not taxable in India. But supply of services is something which is taxable in India. If you create permanent establishment for your supply of services, there's different tax application. So all the scope of work or all the portion of services might have different tax implications. So when we are looking at agreement drafting, it's important to understand what should be my contract structure. So it's important that the scope of work, even though it has nothing to do with tax, primarily the scope of work should be clearly defined in a separate bracket. A separate price element should be allocated to separate elements. So if I'm looking into a contract where I'm saying 200 rupees is portion, where I do everything, I'll supply you goods, I'll provide you services, uniform installation, everything. But you know that supply of services is taxable in India, supply of goods is not taxable. So you have to really bifurcate in the agreement itself that 150 is allocated to supply of goods, 50 is allocated to services, so 150 is something which I will not tax in India, 50 is something which I will become tax in India. And in the agreement as a lawyer, I clearly bifurcate what is the scope of supply, what is the scope of services, what is the price, how the coding will be done, how the subject will be done, everything gets clarified. So contract structure overall from tax perspective becomes relevant. As a lawyer, even if you are not dealing with tax, at least sit with the tax person, understand what to be implicated, then start drafting the agreement. Tax advisor at times may suggest you, depending on case by case basis, that you have different agreement for supply, for services, for installation, for training. So even if there is a one project, you will find advisors for different contracts which you need to do. So how would you have that agreement? Whether you have a umbrella agreement, under which we have different purchase order from the party, whatever the rate, the negotiation happening, the rate case by case basis, we have a better tax efficiency created with any party. Then related party transaction, so in today's case we usually see that when maybe a foreign company wants to have Indian market access, they would create a subsidiary in India. A lot of foreign companies, they all have subsidiaries in India. And whenever they are entering into a transaction or something called transfer pricing, which is generally applicable in India, and transfer pricing is something which is nothing but when I am dealing with a related party, I have tendency to adjust my pricing so as to avoid maybe paying taxes in India and shift entire profit, for example, to some place in Dubai or British Virgin Islands or somewhere where there is either low tax or no tax. So to avoid all those scenarios, something called transfer pricing which is applicable in India, and therefore to ensure that the prices are done at arm's length, a fair market value. These rules are applicable. So if Mercedes Germany and Mercedes India have to enter into any transaction, they have to ensure that they enter into the transaction with a fair market value. Otherwise, there would be a tax adjustment made, and the tax demand would be raised either on Germany or India, depending on the case. Go to the next one. Next one. Yeah.
So my question is, if the GST will be applied to the customer duty also, then won't it create a barrier for foreign goods to be available to the Indian customers?
Sorry.
Good morning, sir. My question is, if GST will be applied to the customer duty also, then won't it create a barrier for foreign goods to be available to the Indian customers?
Last question. Would it be?
Won't it create a barrier for foreign goods to be available to the Indian customers?
Of course, I mean custom duty itself is a barrier. When we are talking about trade barriers, there are various barriers which India has. And it's a problem which India has created. When we are talking about barriers, there are certainly So when we are talking about barriers, there are two different kinds of barriers. One is tariff barrier, custom duty, which has a cost element, and then there is a non-tariff barrier. For example, you have something called Make in India, where you have a local content. So government would say you have to have a local content of 50%. The foreign company of creating an artificial barrier, the foreign company, unless they have some substantial presence in India, and cannot meet that 51% criteria or 25%, depending on ministry to ministry. So that's a barrier. You have a quality control order, BIS. So there's something called ISI mark, which used to happen a long time back. Now there's something called BIS. So government would say you need a BIS certification to import into India. And BIS certification is so complex that as a foreign supplier, for example, if it's made applicable on Volkswagen or Mercedes or Porsche. Okay. Now Porsche needs to have BIS certification from Indian authorities. For getting that, somebody from Indian authority, BIS official, they will travel to Germany or France where the factory is located. They will check the factory in Germany and then they will give the certification, and then only you can import the Porsche in India. It's not applicable to Porsche, it's given an example. So that's a non-tariff barrier. Now on tariff barrier, of course, custom duty is something which is a barrier. GST is something which is applied, but it's not a barrier, because whenever you are paying GST as an importer to a foreign company, you get input credit of that GST. So, for example, if 100 rupees is my purchase price, I apply 10% custom duty, 110 is my custom duty, on which I then apply, say, 10% GST on it. 5%, 10%, to make it simple, 10%. Now, the GST portion which you have paid, that becomes your input GST, and whenever at the end of the month you have sale or you have any output GST, you can offset that input GST and you have to only make balance GST. So it does not become the cost to the supply chain or landed cost, only custom duty. But having said that, GST is per se not the barrier because you have credit available to you. But custom duty is a barrier. There are different forms of tariff again. You have simple custom duty, many a times government also imposes anti-dumping duty. Specifically with China, you will see cotton or toys. China really tried to dump India market with very cheap quality toys or steel, whatever. So if any Indian supplier sees there is something dumping going on, they can complain to the Indian government. Indian government would start an investigation, will carry out and see if the Indian market is being creating some challenge because of this dumping. So they can levy the anti-dumping duty over and above that custom duty. So maybe they can apply 25% anti-dumping duty. So then any importer would have to pay additional 25% duty, and that becomes so bad. Then you have a custom duty of 35%. So to answer your question, GST is not a barrier. GST is just something which you pay in the beginning, you get credit at the end. It impacts your cash flow statement, but not a barrier. Any other questions so far in any topic we have covered? Yeah. So share purchase agreement is something which is again very important, relevant topic as a lawyer. Very often you will listen or work on this share purchase agreement. But there's something where, just to give an example, a foreign company from US had an Indian company. It now wants to exit, and somebody from Netherlands wants to acquire the Indian subsidiary. So you enter into share purchase agreement between a US company and a Netherlands company, but the subject matter, the shares which are being transferred from US company to Netherlands company is of an Indian company. And because the shares are located in India, you have to see whether you have any tax application. Now luckily we do not have to talk about GST custom duty here, but income tax, the capital gain tax is something which is very relevant here, which we have to deal in. Now when we are talking about capital gain tax, whenever we are selling share, capital gain tax is applicable, and the way it is computed is that you have a sales consideration which has to be a fair market value depending on DCF. You also have foreign exchange regulation which RBI levies. So sales consideration at fair market value is something to take as a base. Then you reduce cost of acquisition. So when US company is selling those shares to a Netherlands company, they will have some income from sale. Then whatever purchase price they would have incurred by establishing the company or by purchasing the company earlier, they can reduce that cost, and whatever balance comes, certain expenditure which are directly related to the share transfer is something which you get an additional deduction for, and balance is capital gain tax, and then it is classified as either the long-term capital gain tax or a short-term, depending on whether it's held for more than 24 months or less than 24 months. Now, if it's a long-term capital gain tax, you have a tax rate of 12.5%. If you have a more than 24 months holding, you have a tax rate of 35% for a foreign company. So, sales consideration is important. It's important that capital gain tax is applicable, and most important is that again withholding tax is applicable on the transfer of share when any Indian party is making to foreign company, or even in this case when there is a two foreign company, one is US company, one is Netherlands company, nothing to do with India, but they are transferring the Indian share. They have to ensure that withholding tax, Netherlands company is making payment to US company, they have to withhold tax. So they have to get withholding tax registration and number. Whenever they are making payment, they have to withhold tax, and then after the withholding tax, they can make the payment of share purchase. So as a lawyer, you will deal with share purchase agreement very often. There will be different party, either through non-resident, one resident, or whatever the case may be. But it's important that you understand that whenever you're looking at any SPA, there will be certain tax application, there will be certain capital gain tax aspect that you need to understand. How would withholding be done, whether they will be grossing up, letting up, etc. And also, when we are looking at capital gain. So as I mentioned, it's only on the gain portion on which tax applies. So if you have to apply 12.5% on the gain portion, now when Netherlands company makes payment to a US company, the Indian tax law says that you pay tax on 12.5% on the consideration which you are making payment to. I am not concerned about the gain portion. So it may happen that you have a sales consideration of 100, but you have gain of only 10, and tax applies only on 10 rupees. Whether, but when you are interested in government, maybe they have to file a tax return, claim a tax refund, that in itself is a challenge to receive a tax refund specifically for a foreign company having no bank account in India. So there is an option available under the Indian law that the party US company can apply for the lower withholding tax certificate. They can present the calculation to the Indian tax officer and say, see, sir, I am trying to sell this share and my actual tax cost, final tax cost is this, but if I go with the law, I have to pay this cost. So please give me a lower withholding tax certificate so that the other party will put there's an actual tax on my payment, otherwise it will be a genuine hardship. So as a lawyer, I need to understand, advise my client that there is a lower withholding tax option available. I should enter this into an agreement. What should be the timeline followed, what should be the document which should be received, all those aspects must be covered. But even if I am not taking care of tax, at least when I am dealing with an FTA, I should sit with the tax lawyer, understand, highlight all these concerns, and then ensure that properly agreement drafting is done. So as a lawyer, you will have to really draft the agreement, you will have to understand the clauses by taking support from tax expert if you are not. Now, payment of withholding tax already covered, then indemnification and other voluntary, similar to what we talked about in the first slide, that there may be indemnification, there may be voluntary, etc. when we talked about labor to agreement. It also has tax coming to it, so it's important as a lawyer that we again relook at all those clauses. If certain indemnification is to be done, whether withholding applies on those indemnification, whether any compliance needs to be done for those indemnification from tax perspective, all those aspects is also covered when we are drafting indemnification for FTA. Specifically, representation, indemnification is very, very important. Due diligence is important for FTA. After due diligence as a lawyer, I need to read the due diligence report and ensure that all those concerns which are highlighted in due diligence is specifically covered under warranties, representation, and drafted accordingly. Now, coming on to the joint development agreement, in the interest of time, I will very quickly cover the aspect also. So, we already talked about the goods and service part. The joint development agreement is something where if I have a piece of land and I approach a developer, then let us just utilize this piece of land, develop something, and then either it can be meant for sale that either developers sell their product, the final real estate to a customer, or the landowner says, you transfer that to me, you just have developing right, and I will sell to the end customer, or I don't need anything, you take half of the property, I take half of the property, and then we do whatever we want on that. So this is the way agreement is done, and in that case, the landowner provides developing rights to the developer. Next slide, please. Next slide. Next slide. Now, when we are talking about development rights, it's treated as supply of services. So as a landowner, whenever I am giving the development rights to the developer, it's treated as supply of services, and therefore GST is applicable on that. There are different valuation rules to compute on what component will really have to apply it is provided in the notification. But the bottom line is that GST is applicable whenever I am entering into the agreement to provide development rights to the developer. Now, if it is a case of a case where it's not meant for sale, the developing rights, the end products are not meant for sale, then the landowner is responsible for paying the GST on forward charge basis. But if it is a case where it's meant for sale, then the developer is required to pay GST on reverse charge basis. So even though payment is made by the developer, or it's getting the hypothetical amount of the land development services, the GST would be paid by the Then at times we are looking at construction services, because what actually developer is doing is providing construction services to the landowner. So this is again considered as a supply of services, and GST is applicable on the same logic at the same time which was applicable when we are talking about the development. So the bottom line is that whenever we are talks about the joint development agreement. There's of course one income tax aspect that we should consider, and that's very simple. That in case I am earning an income, even though it's a hypothetical income tax easy application, I will be ready. When we are looking at goods and service tax, the tax applicable to two aspects. One is the development rights, which is given by the landowner and the developer, and then there is the second aspect of deemed construction services or actual construction services which are provided by the government. GST is applicable on both. Different forms of GST is applicable. For example, like construction services is a valuation rule that we will compute the actual sale price and then use the 1/3 of the sale price as a land value and on the net amount GST is something. So that was it from my side on different elements. The idea was to really highlight that as a lawyer there will be different elements that should come up. What are different tax law which we are talking about, laws which we are looking at. And as a corporate lawyer and an litigator, at least basic only you should understand from tax perspective. So that tomorrow when you are going for internship and you go for law, you have some idea on that there is some tax after that you should look at. And then we can see a couple of things. Thank you.
That was indeed a third question. On behalf of Decoding Business School, I extend my heartfelt gratitude to our distinguished speaker for taking time to share his valuable expertise with us. For his valuable contribution, we would like to present a memento and thanks letter as a small token of our gratitude. I would like to invite Dr. Nidhi Sharma ma'am to do the honors. And to formally express our appreciation, I will now again invite Dr. Nidhi Sharma ma'am to deliver the vote of thanks.
Good afternoon to one and all present over here. So on behalf of Decoding International Business School, I take this opportunity to present vote of thanks to those who have directly and indirectly contributed to this lecture on Decoding Joint Development Agreement GST Implications that has been organized by our institution. I thank our resource person, Mr. Gaurav Makhijani sir, for his commendable effort in conducting this event. We are really enlightened with your knowledge and presence, sir. We are also thankful to our Honorable Chairman sir, Vice Chairman sir, and Dean ma'am for their support and motivation in organizing such events. Last but not the least, heartfelt thankful to our students for active participation. With these warm words and a kind message, we move to the end of today's event. Thank you so much.